please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this very special sit-down with the top team at Standard Chartered Bank. We're talking about global growth, global economics, and when we're talking about those things nowadays, there's only one thing which dominates the narrative. This is Mr. Trump and his conversation, his tweets, and his communication, said and unsaid to the outside world. People are left guessing. I'm sitting down with David Mann, who's the Global Chief Economist at Standard Chartered Bank, and Eric Robertson, who's the Head of Global Macro Strategy at the bank. Gentlemen, thank you very much, both of you, for being here.
Thank you.
I think we begin, of course, with the G6+1, the G7 meeting we just finished over the weekend. The way it ended, a statement was put out and Mr. Trump came out and, while on his way to Singapore, tweeted stuff which basically blew up the statement. Your assessment of what that has done to the credibility of the G7 and essentially the partnership?
Well, we would argue that it's been the case for a number of years that the more relevant entity is really the G20. Even though it contains arguably too many economies, it does at least include the ones that are more relevant in terms of accounting for a large share of global growth. These days, Asia accounts for about 60% of world growth if you use PPP exchange rates, and in the G6+1, they're not in there. So I think the amount of attention that's given to communiques coming from the G7 over the years has been going down, certainly compared to 10 or 20 years ago. So in that way, I don't think you'll get a big market reaction. Also, I don't think they should be too shocked that we have seen this sort of more animosity created by some of the tensions through what usually are usually never the case with these allies.
But expectations were already running pretty low, right? I mean, that they will be, to begin with, a joint statement in the first place. But, well, we got that. And then, we got Mr. Trump's tweets.
That's right, and it's therefore no one's really too shocked that whatever the statement ended up being was one that did not get the full support of the largest or most significant member, because we are in a different world in terms of the way that all of these norms work compared to what we've been used to. That's right.
Eric, will this roil forex markets more? I mean, emerging market currencies have had it pretty bad this year. So
no, I don't think so. And you're correct. It's been a volatile year for emerging markets, but I don't think the tweets from President Trump over the weekend will necessarily exacerbate that. We've gotten used to an environment in the markets where, Trump has made it very clear that he wants to operate, whether it's with trade or other treaties, other negotiations, on a country-by-country basis. And these large multilateral organizations, he believes, are inefficient. So I think this is really more of the same. I think we've got some bigger issues to think about for emerging markets, whether it's the increase in U.S. interest rates or the strength of the dollar recently, oil prices, etc. And obviously we have a rather important summit in Singapore this week.
David, but it's very clear, as both of you also agree, that he's made it clear he wants to deal with issues country by country and not on these big forums, right? So what does that really mean? The existing order, as many have put it, is sort of up for renegotiation completely, overhaul?
Well, we've already been going down that route of just piecing together like a giant spaghetti mess, all of the different individual bilateral deals to try and then figure out, can we then turn that into something at least regional and then link the regions together. The WTO process, for example, has been stalled for a lot longer than President Trump has been in office, and protectionism as a trend, that's something that was well underway even 10 years ago. We've been counting the number of protectionist measures taken by various countries over the last 10 years, and actually the US has been implementing more measures than anybody else. So that tend towards being a little bit less into the let's just use up all the low-hanging fruit that's already gone, has already been gone for quite some time. I think what we're focused on now is, can you at least resuscitate some of those regional deals? And I would say the jury is still out on that. But expectations, certainly, does it matter for the markets at this stage, are very, very low. I think the thing that the markets are more worried about is, do you end up somehow in some sort of negative trade war spiral?
What is the number one issue for markets, forex markets and other markets, according to you right now?
I think there's two. The first of which is the Federal Reserve and how far they will lift interest rates.
Sure.
The increase in U.S. interest rates since, let's call it September of last year, has been around 100 basis points in 10-year yields, and more than that at the front end of the curve. So we have seen a significant flattening of the U.S. yield curve. I think for emerging markets more specifically, the increase in the dollar and the increase in oil prices at the same time means that in local currency terms, oil prices have gone up dramatically, and the potential spillover to inflation has now forced some of the central banks in Asia and other emerging markets to raise interest rates to defend their currencies. And I think that's something the markets have struggled with.
Fair enough. But if he were to, as David mentioned, get a trade war spiral, right? I mean, the common view right now is that Mr. Trump is a smart man. He's been a businessman. This is all negotiation, and his opening sort of gambit is pretty tough, and then he kind of sort of waters down, he backtracks, etc. What if other countries were to do the same, and then if it spirals out of control in that sense? I mean, would that be a big worry, or?
It is a concern. For the moment, I think our view is that it remains what we would call a fat tail or a black swan event. I think, as David mentioned, most of the countries involved in these negotiations have taken a very interesting approach, which is to focus on industries or sectors in terms of their retaliation measures, which may garner large headlines, but in terms of the overall economic impact would still be relatively small. Now, if we can stay within that construct where there is a tit for tat, such that both leaders or countries can go back to their voters and constituents and say, we have achieved this victory in our trade negotiations, I think we can avoid that fat tail event. But the risk is still very much out there.
Any way to put numbers, probabilities to this kind of thing?
Well, it's always very hard on probabilities. I would say the probability of having a worldwide trade war of the type that we saw in the 1930s is extremely low. And the main reason I say that is that right now there's really been one main source of the issues, and it's been the US. Others, for example, even with the TPP negotiations, even the RCEP, there are at least some versions of it still out there that people want to continue along that path. There is a coalition of the willing. So it's not as if you have everyone saying, oh, well, it's working for the US, let's all do this. I don't think you're going to go down that path. I think everyone else would rather just ride this out, take the assumption that actually let's follow the actions rather than the words, and there's a big difference still between the two, and focus in on the fact that actually it's still in our interest to continue to stay as globalized as we are, especially with supply chains being as complex as they actually are. One point we make on why we think the US would be suffering itself from doing anything too overly draconian is that the US itself is the fourth biggest supplier within the supply chain of what China sells to the US.
Okay.
So this is a big difference compared to, say, a long time ago where you didn't have such complex supply chains where everyone was so interdependent. And I think that recognition means that people do want to avoid the worst case. They know what it can do, and they're trying to stay away from it.
But to be sure, we had Canada, I mean, of all countries, coming out and saying that we will not be pushed around. I mean, that was unusual coming in from the leader of Canada, right?
Right, but again, it's very US focused.
Yes.
It's not as if Canada then said, okay, and now we will implement measures, and we're focusing in on our trade with Germany and trying to copy the similar style of what we've seen elsewhere. I think instead it's very zoomed in around one particular trade relationship, an important one, but to be fair, the other interesting part of this is if we zoom it back into this Asia region, is that actually the economic relationship between the US and the markets in Asia has declined substantially from where it was 10 or 20 years ago. Meanwhile, the region itself, particularly China with other markets in the region, that economic relationship has improved, and there's no signs that anyone there is trying to go in that similar direction that we've seen elsewhere.
What would, to you, both of you, constitute a trade war? I mean, at what level will we say, okay, here's the alarm?
Certainly, if you were to take it from the U.S. vantage point, I think if the U.S. were to go beyond aluminium and steel with China, for example, and really implement quite a bit of tariffs against technology companies, impose quite stringent restrictions on China's ability to export technology products into the U.S., or on the other side of the equation to invest or participate in joint ventures. I think for me that would be a telltale sign that we've gone past an important demarcation line. And I think that's where you could see some of the regional trade agreements really start to spiral into a new world. As David mentions, one of the risks and potential silver linings of these trade negotiations is that if the U.S. really does withdraw, you're going to see an explosion in trade deals within Asia or between China and Russia, for example. So I think there's always the other side of that coin.
And you're also not really seeing the U.S. just outright saying, that we want to apply tariffs on everyone, we're going after everyone. Instead, actually, we hear more and more that there are countries in Asia where they don't get that message at all, that actually they're still open for business. And actually, if you look at how world trade has been doing this year, it's growing about as fast, maybe slightly under where it was last year, which was a significant improvement from 2016. So the underlying fundamentals are still looking fairly good, and nothing so far has sidetracked that. Now, what could sidetrack it, I would say a little bit really on something that's a bit too broad, where it's across the board tariffs on everything coming in from China. We're going to apply tariffs, and we've looked into some of those tail risk scenarios, and in those scenarios, for example, of say China being told everything gets a major tariff, let's say a 25% tariff, there is a significant economic impact, but
the probability of that is very low, as you're saying.
We would say it's quite low, yes.
But India has come up. I mean, I think Mr. Trump mentioned India, saying that, well, India has import duties of 100%, up to 100% on some products, and we can't allow this. And if this continues, then we will stop trading with countries like that. And this is not the first time that India has come up in these trade and sort of protectionist conversations. Have you looked at the sensitivity of countries? Where does India figure in that list if we were to eventually get to a trade war kind of situation?
Well, the way that we would look at it, particularly for, I mean, China is not quite as extreme, but in India's case, it's actually not a huge part of the economy, the external sector, compared to the scale of the domestic economy. Now, you can argue, well, if the export sector were hit very hard, that should also feed into impacting on investment. But ultimately, nothing would happen in a vacuum. And you would get reactions, responses, you'd get actions to try and support growth and to encourage more investment. So actually, we don't see that, firstly, as being a very likely scenario. I think it's more a case of watch the actions rather than words. So we don't see that as being high probability, more discussed. And secondly, we don't believe that in itself would have a particularly large impact.
Let's move on to currencies. So what are we seeing what's your forecast as far as the dollar itself is concerned for the rest of 2018? We're starting to see maybe the dollar topping out maybe here?
That's certainly our view. We have been fairly negative on the dollar for the better part of 18 months. The last couple of months has been challenging for that view, but our expectation is that the dollar will start to decline again in the second half of the year. First of all, expectations around the Fed and how far they will take this tightening cycle are starting to flatten out or level off into next year. We think that's important. The U.S. yield curve, as I mentioned earlier, continues to flatten, which historically is associated with a weaker dollar. And in terms of the other side of the ledger, which is foreign currencies and how they'll perform, we do expect, certainly on a selective basis, but at the moment we do expect emerging market currencies in a number of places to start to recover. A number of these exogenous factors have started to stabilize. And I think more importantly, as David mentioned, the underlying economic fundamentals for EM are still relatively robust. The growth slowdown narrative, which we heard repeatedly in the early part of the year, we think that is overstated. Inflation in a number of parts of the world remains well below 10-year averages, even with the increase in oil prices. So I think there is a very good case for a recovery in EM in the second half of the year.
In terms of yields, the 10-year on the US, you think it'll stay under 3% or it could?
Our expectation is that the 10-year yield will finish the year above 3%, but I want to clarify that or add some color. It's not an expectation for a significant move higher.
Okay.
We see 10-year yields centering or finishing the year around the sort of 310, 320 area. For us, the big increase in yields is still going to occur at the front end of the yield curve. So by the end of the year, we would expect the U.S. Treasury yield curve to be completely flat from a current level of about 40 basis points.
So we've got 3 central bank meetings, right? I mean, Fed, ECB, and the Bank of Japan this week.
Yeah.
Fed expected to hike 25 basis points, and the other 2 to stay pat?
Yes. The important part with the other 2 will be discussions around their meeting and program rather than any action. That's for sure. Yeah.
Okay. In terms of emerging market currencies, do you think it's, I mean, the Turkish lira, for example, or what's happening in South Africa or Brazil or all these currencies, is there the common thread is QE ending and markets having to price assets without QE? I mean, central banks behind them?
I think there's an element of truth to the shrinkage of balance sheets and you know, some have called it quantitative tightening. I think there is an element of a drain of liquidity. But But at the end of the day, I think what has really been troubling for a number of these markets that you've just described, whether it's India and Indonesia earlier in the year, South Africa more recently, Turkey, is the increase in oil prices and the increase in the dollar at the same time. Right?
But both can't go on, right? I mean,
this is, well, they can.
Yeah.
The old saying is markets can be irrational longer than you can remain solvent, I think is always something to keep in mind. But it is a break from historical correlations. Historically, when commodity prices are rallying, you would expect to see foreign currencies rallying or the dollar weakening. That gives central banks an important bit of policy flexibility, which they've lost over the last couple of months.
Sure.
So you see, for example, the central bank in Turkey, now Brazil, India, Indonesia, adjusting their policy path to try and defend their currency, to inject some stability. Now, it's our expectation that oil prices will be more stable around current levels. If our dollar view comes into play, all of a sudden central banks will find themselves with an enormous amount of policy flexibility. And you saw that in Brazil at the end of last week.
Sure.
India and Indonesia have already started to perform quite a bit better over the last few weeks. So yes, liquidity is important, but there are other factors as well.
So what's the view on oil, the house view on oil, David?
Well, we've been historically pretty bullish for a number of years on where oil would go. And the key underlying driver was demand was never really the issue. It's always been relatively decent pace of growth, driven, again, by the emerging markets, more even than developed markets in terms of the delta. What's been the biggest story was to do with shale, US shale production, how much it would be able to survive and then to pick up. Now, the stage that we're at, what we're watching for is that with the oil price targets, implicit targets, effectively met, and the achievements of the collaboration between OPEC and other countries has achieved their objectives, now we may end up, because we're risking going outside of the Goldilocks range for oil prices. And that's something that we need to be wary of, because we would have expected that shale could have taken up even more of the slack. But there's a lot of drop in supply coming. One, it came in from Venezuela. Two, from what we are likely to see from Iran's output post Trump's announcement again on the deal.
Sure.
So this means that we're in a more precarious situation on the inventory side. And that means that if there's any risk to our view, which is we stay where we are at least and maybe slightly higher, that it's actually upside risk still to where oil prices go. And that, I would argue that once you get WTI in the mid-80s or high 80s, that becomes no longer really the Goldilocks scenario that we had been anticipating.
It's great for producers, but it starts to hurt consumers.
Yeah, well, the other challenge for producers is if you go up that high, it also removes some of the more urgent need for reform. And so actually, Goldilocks from many perspectives would be if we were, say, around where we are today.
And you think most likely that is the case?
We think so. We think we will start to see a little bit of output picking up, for example, from Saudi over the coming months. And there will be some producers that can meet some of the drops in others' output to try to stabilize prices. So I would say and this underlying demand story, as I say, the underlying fundamentals are still relatively strong. And they're unimpacted, we would say, so far on a worldwide basis. And I think this will be true for a number of years, unimpacted by the electric vehicles.
India, where do you stand? The rupee, the strength of the local economy in the global setup, Rick?
Yeah, I think, look, India has had a couple of challenges this year, some of them domestic, some of them what I would call exogenous factors. On the exogenous side, as we mentioned, the increase in U.S. interest rates, the increase in the dollar. India, as you've just alluded to, is an important importer of oil. So oil prices going up as dramatically as they have, combined with currency weakness, you see a real deterioration in what we call the terms of trade, right? And that's something that the RBI has been quite heavily focused on recently. The other issue is the bond market. Right? In an environment where global interest rates are going higher, we have seen demand for the onshore government bond market decline. We've seen 10-year yields up around 8%, which is historically quite a high level. The spread on 10-year yields relative to the repo rate remains quite high. So our argument at the moment is valuations for Indian assets, whether it's the currency or fixed income, are extremely attractive, but you need to see some signs of stability. I think the Reserve Bank of India's decision to start raising interest rates is an incredibly important marker. I think it will be the start of an inflection point where you will see Indian assets start to perform better because the RBI is saying we want to get out in front of the curve.
do you think there's only one rate hike here, or there's never one rate hike? I mean, it's the start of the cycle.
Well, you never say never, but our expectation is that there will be a follow-up rate hike in August.
Okay, and beyond that, it's not a deeper rate hike cycle in that sense, you think?
I think I would make the comment for India, which is similar to what we have expected in a number of other economies around the world, especially in the emerging economies, which is that we have expected a mild normalization of policy, one, maybe two rate hikes. Beyond that, I think is very difficult to expect much more. We've seen a couple of rate hikes in Indonesia, similar in Korea, but again, we're not expecting a steep policy trajectory, and I think that's quite important.
And if I may jump in, actually, the reason that we would argue ahead of consensus and expecting the hike that we just got was because of this combination of looking at what was going on elsewhere, thinking, why not be preemptive? And on top of that, factoring in the impact from the rise in oil prices, given its importance on driving inflation. And if you're more upfront about it, then you may end up needing to do less. So the key driver of whether or not we'll call for many more to come, or actually only one more to come, which is all we're calling for, will end up being on this external issues to do with how the currency is performing.
We'll leave it there. Thank you very much, David and Eric. Appreciate both of you coming in and speaking with us. Thanks indeed.
Thank you.
Thank you very much.